Boom, there it is, ladies and gents. We're ready to rock and roll as we root on USA. I had to pause the game for a second so we can do a little bit of business talk. We're talking valuating a business. So let's jump into this one. If you want to know what your business is worth or how to set it up, this one's for you. Here we go.
Shut up and sit down.
Look, a business can give you everything you want in life. Prestige, wealth, freedom. It can also take everything away from you. This show is for those who are willing to take that risk. These are the real life stories of entrepreneurs. But before we start, I have one small favor to ask. Please leave a comment. It can be advice, critiques, tips, feedback, or share this with someone because your engagement is the most valuable and most powerful form of social currency. So thank you, and welcome to another episode of Business Boss.
All right, ladies and gents, when you start a business, you should begin with the end in mind. How are you going to exit this business? Building a business you can walk away from is the objective of elite entrepreneurs, and part of exiting is the valuation of your business. There are many ways to evaluate a business, but when it comes to investment banks, the truth lies in the numbers. So let's get ready to talk valuations, mergers, and acquisitions with Mr. Channing Hamlet. Mr. Hamlet, welcome to the program, my friend.
Hey, thanks for having me. I'm really excited to be here.
All right, let's talk about this. In my class, I teach a class called Financial Algebra. It's a lot of life skills, and then we also jump into some business stuff as well. One of the fun things that we do in class is we watch Shark Tank, and then we create some marketing campaigns for the different products we see on Shark Tank. But cool. Some of the things that really stick out to me, because I know my kids look at those numbers with, like question marks in their eyes, they don't quite understand, is what is a valuation? You hear them talk about it all the time on Shark Tank. They come in, they ask for a certain amount of money, for a certain amount of equity, and that somehow equates to a valuation. So I'm kind of laying it out here for you. So can you start with what is a valuation, and then how'd you get into this space?
Yeah, so it's interesting. Evaluation, it can be really complex, but quite simply, evaluation is, what is the company worth? And there's a lot of different techniques that can get used to come up with evaluation. Specifically with Shark Tank, most of those companies are early stage companies where the investor isn't necessarily investing in the value of the company today. The discussion about evaluation, investing in an early stage or venture company, is as much about, at the end of the day, when we sell or exit this business, who gets what. And so in an early stage company, if you kind of say, look, I raised $5 million at a $10 million pre-money valuation, I have a $15 million value. It doesn't necessarily mean your company is worth 15 million that day. What it means is the investor who invested 5 million divided by 15 owns 1/3 of the business. And so then the way a Shark Tank investor is looking at this is, if I own 1/3 of the company in my example, what am I likely to get as far as a return on my investment 2 years, 3 years, 5 years, 10 years when this sells? And so really in the early stage companies in Shark Tank, it's as much about, at the end of the day, when you exit, who gets what. It's not necessarily what the company is worth. That's really the basis for that discussion. Completely separate from a mature established business where a business owner or a group of shareholders is thinking about selling the company today, where really the person who's going to purchase that company and operating it going forward is going to write a check for that value today. They're similar but different discussions, if that makes sense.
Yeah, totally makes sense, because it's kind of like kids growing up, right? They start off as infants, they get to toddlers, and then they become young children, then they're in adolescents, teenagers. We all have phases in our life, and a business naturally has its own phases. It needs a little help at the beginning. So exactly. The valuation might be different versus when you're exiting, what that's going to look like. So tell me a little bit about yourself. How'd you get into this space? What's your criteria here?
It's an interesting journey. Long story short, I graduated with a technical degree from college, and always was interested in business, and got into investment banking a couple years out of college. And I worked at a group on the East Coast called Legg Mason, and mostly focused on kind of general corporate finance stuff with a real emphasis on mergers and acquisitions. And most of the work I did in the early years of my career was helping business owners sell their companies. And the average transaction I worked on, or the transactions I worked on, were kind of between 10 million and $1 billion in value. Most of those were sort of family held or entrepreneur owned businesses, and really fell in love with helping families and entrepreneurs when it came time to exit their companies. So that was the early part of my career. Then I switched gears after working for 7 or 8 years and worked at a private equity firm where we invested in and bought companies. And while I was there, we invested in about 20 companies or so. And then through some family circumstances, moved out to the West Coast and kind of took a little bit of an entrepreneurial journey where I've started a couple of firms that do investment banking and valuation. The current firm I'm at, Objective, I joined about 10 years ago, and we have a group that does business appraisal. We have about 10 folks doing that, and then we have about 15 people doing investment banking, where we're representing business owners selling their companies. And I've been doing this coming up on 30 years now. Somehow, it's hard to imagine.
Man, time flies. So you've been
no
all
kidding.
around. You've been at the beginning where you're creating, where you're investing in companies at the very beginning of their life, the Shark Tank era. You've been at the exit side. You've been even on the building the investment banking side to evaluate a lot of these different companies. So let's start from the beginning then. We already started with, what is the type of valuation needed for a startup. So what are some of the like negative sides of that? Because and for me, it's like, every time I watch Shark Tank, there's two trains of thoughts. One, that you need to raise revenue, and the other thought is you're looking for specific partners to come in and help grow that particular business. But you're also giving up equity in doing so. Kind of hinders you. Now that you've been in at the beginning all the way through to the end, what are some little maybe caveats or questions or things that newer businesses should be thinking about when they're looking to raise capital while also having that end in mind?
It's a great question, and there's a lot that goes on with it. I think the biggest thing that a lot of entrepreneurs kind of come in thinking is like, hey, this investor is going to write me a check, and then I'm going to go and use their money to do whatever I do and build my business. And so I think that most investors typically want to have a fairly significant amount of involvement in the business and a lot of protective provisions and other terms and things like that. And I've seen a lot of entrepreneurs make mistakes with not really thinking that through. It's really exciting at the beginning to raise money, but really having the discipline to take a step back and think 3 years down the road, 5 years down the road, 10 years down the road, and understand like, hey, what is it I'm signing up for? Like, for example, at the private equity firm that I work for, we invested in a number of companies, and this is a very common thing with investors. We invested in a number of companies where we would make an investment. And since we're a fund and an investor, our goal is different than the company we've invested in. The owner or entrepreneur's goal is like, hey, I'm really excited about operating my company. I want to build it. I want to grow it. I want to do something cool here. The investor is like, hey, I'm giving you some money today, and I want to make a financial return on my investment. And so the valuation is set up so that the investor can make a financial return. And, that typically makes sense to the entrepreneur, it makes sense to the investor, et cetera. However, there are a lot of other terms there that are really important. Most investors will ask for some protective provisions, some covenants. Many investors will have the right or the ability to sell their shares back to the company. And it's easy for an entrepreneur to sort of like, oh, I'm just going to kick the can down the road and I'll worry about that later. However, 5 years goes by pretty quick. And in 5 years, if the company hasn't quite made the progress that the entrepreneur or founder wanted, or if things aren't going well, or if they're really excited about where things are going, the investor can show up one day and be like, oh, hey, I've decided to sell the company, or I've decided to do this, or I've decided to do that. And you gave that right away 5 years ago when you took their money. And so really taking a step back and understanding all of the terms and all of the strings attached that come with that initial investment, that's probably one of the largest mistakes I see, entrepreneurs and founders make. On the other side of that, as an entrepreneur and founder, it's hard to raise money. And I think just recognizing that the money comes with strings attached and truly understanding what you're signing up for is really important. When I've seen a lot of situations where investors and entrepreneurs aren't necessarily getting along and aren't aligned. And usually it stems from some sort of misalignment right from the beginning in terms of an understanding of the terms and making sure they make sense. So that's like the biggest thing that I tell people to look for. And then I think the second thing in terms of the question you asked was around valuation. And I think, every company is different. Every industry is valued differently. And investors are typically they're looking at other similar investments they've made or other similar investments they're aware of in terms of, how much money am I investing? How much of the company do I need to own? How big can this be? What's the likelihood of success, et cetera, et cetera, et cetera. And so I think as a founder or entrepreneur raising money, really working on your pitch so that as you're presenting it to the investor, being realistic about the size of the opportunity and doing as much as you possibly can to demonstrate that it's highly likely that you're going to be successful and make it feel as real as possible. And that's one of the reasons you mentioned revenue traction. One of the biggest things you can do if you start a company is have some traction in the market, because then it's no longer an idea, it's proven and customers are buying it. And so the more traction you can have, the easier it is to convince investors that the opportunity is real, it's happening, and that they should jump in.
Yeah, once you get that energy up, people are excited. It gets a little bit easier. You mentioned and like the main point I feel I got out of that, big investors people who are raising capital should pay attention to the fine print. Get a lawyer, get an attorney, have a team, take a look at the fine print, completely understand what you're getting along with the money, the investment capital that you're getting when you raise funds. From the investor side, what kinds of terms or recourse do they have? Because I would be worried, especially with a startup, the failure rate of startups are so high. So sometimes taking a gamble on a company that is pre-market or hasn't actually sold, maybe they're in tooling phase, maybe they have patent pendings, maybe they're early on, doesn't necessarily mean that they're guaranteed success afterwards. The market might not be there, or for whatever reason, things might pop up. So as an investor, what kinds of terms and recourses are built into some of these mergers, acquisitions, these different fundraising that allows them to come back and grab some of that, or maybe sell that company like you were kind of explaining?
Yeah, it's interesting. We've spent a lot of time talking about early stage investments, but even in a later stage company, when the owner is thinking about selling the company, the buyer typically asks the seller to sign a number of representations and warranties. So we always, when we're working with a business owner selling their company, we're always talking to them. There are two really important terms. One is, how much are you selling your company for? And then the second one is, what post-transaction liability are you retaining? So the buyers typically ask the seller to sign representations and warranties and hold money back in escrow and have the ability, to the extent that liabilities come up in the future, to claw back money from the seller. And so really understanding that and what you're signing up to, again, is really important in the sale. In the early stage company market, when you really think about it, and I think Shark Tank kind of applies. A lot of the Shark Tank companies are just, very, very early, and they're raising their first money from investors. And if they don't spend that money wisely, or if things don't work out with the company, often there's not a lot of value left at the end of the day. So the recourse that the investor has doesn't from a practical standpoint doesn't necessarily matter, but the money does come in different, in different flavors. And I don't watch Shark Tank a lot, but the few times I've seen it, a lot of the investors in there are talking about investing through a convertible note, where they're going to ask, where they're going to have like a security interest in the company's assets. So if the company defaults on the note, the investor has the ability to come in and come in. Sorry about that.
No worries.
The investor has to come in and foreclose and take over the assets. So there are other forms of securities, whether it's a safe note or preferred stock or equity investments, that give the company and the founder a little bit more latitude in terms of control over the asset going forward. And, that's not necessarily my area of expertise. That's something that an attorney should really be working on and thinking about.
Let me ask you about the changing economy, because interest rates are going up, which means capital is just going to be more expensive. To borrow money is just going to be downright more. It's going to cost you more money, which means liquidity is getting more and more difficult. And so I feel like there's, on the one sense, you have an investor pool that may be drying up, or looking for more specific investments that are probably not burning through cash, that are cash flow positive, probably. But on the other side, we're in an economy also where there's a lot of small businesses that are going to be closing. So the mergers and acquisition aspect of it might be pretty cool to scoop up some additional pieces of your own industry and kind of start building your own little conglomerate, or buying multiple, I don't know, like plumber shops or construction shops. A lot of these small solopreneur companies that are kind of they're either going to age out because their owner's on the way out, or we have an opportunity to buy them out. What's your take on where the economy is and how's it affecting mergers, acquisitions?
It's a super interesting question. And, we've obviously spent a lot of time talking about it internally at our firm, both in our valuation practice and in our mergers and acquisitions practice. We're spending time talking to our clients about it. And it's, I think definitely it's a fluid and evolving situation. But generally speaking, kind of what we're seeing is there's a couple things going on. We're kind of, knock on wood, coming out of this global pandemic where the government did a lot of things to stimulate the economy. And there definitely have been winners and losers through that. So almost any company you look at today was impacted in one way, shape, or form by the pandemic and the government stimulus. A lot of companies were negatively impacted, a lot were positively impacted. And so in the normal environment, you would look at a company and you look at their sort of historical financial performance, and that would be sort of like, hey, if they've been doing X in revenue in the past and they've been growing by this amount, you would kind of expect that sort of trend to continue. We're in a situation right now where it's harder to look at the past to predict the future because of the pandemic. Like, for example, e-commerce companies really accelerated during the pandemic. And so a lot of the people who owned e-commerce companies were like, oh, hey, this is the new normal. I'm going to be growing at 75% a year forever. I'm worth $1 billion. I want to sell. And the buyers of those companies, or the investors in those companies, are like, no, I don't think so. The government printed a bunch of money. Consumers aren't going to retail. Once the pandemic's over, it's going to go back to normal. And we truly don't know what's going to happen with your business. We're going to be more conservative on the valuation. And then you had the flip side, where companies were impacted negatively by COVID because they were shut down, or, customer demand was low, and then it's coming back. And so it's really hard to look historically at companies to understand sort of what they're going to be going forward. So that's just a complexity in and of itself that we've been dealing with for the last kind of 18 to 24 months. Then layer on top of that, increasing inflation and rising interest rates, along with a drop in the stock market. We're seeing pressure on, we're seeing it more difficult for buyers to access capital. Not only is getting a bank loan more expensive, the banks are not as generous with lending money right now as they were 12 months ago. And so what we've seen is there's been in general kind of downward pressure on valuations. So it's harder to sell a company. It's harder to sell a company now because there's less capital available now than there was 6 months ago. And then we've also seen valuations come down. However, what I would say is I started doing this whole, valuation investment banking journey 27, 28 years ago, whatever it was. At that point in time, the rule of thumb was that good companies would sell for kind of 5 or 6 times EBITDA. What we've seen is those same companies 25 years later were selling for 10 to 12 times EBITDA. There was more capital available. Interest rates are low. There's a lot of money that's flown in, that's come into private equity. The stock market was high, et cetera, et cetera, et cetera. And now coming into this newer environment, which we've been in for 6 to 9 months now, depending on kind of how you look at it, valuations have come down, but they're not back to 25 year ago levels. They're still high relative to historical, norms. And so what I kind of see going on with the economy is, we're not going to have the 2021 massive valuations and free flowing money, but we fully expect to have kind of just a normal level of capital available, normal level of valuations, et cetera, et cetera, et cetera. And then the second thing that we're seeing is it's very industry and situation specific. I was talking to a friend of mine that works at a private equity firm yesterday, and what they're seeing is a lot of the companies in some spaces kind of going into a tougher economic environment are turning their attention to acquisitions to drive growth. And so there's more and more pressure on public companies and private equity owned companies to do acquisitions to drive growth, which is a really nice tailwind for business owners that are thinking about selling their companies. So in some sectors, valuations have remained as robust as they were, through 2021. In other sectors, investors and buyers are being more cautious. And so I would say, generally speaking, valuations are down. It's a little bit harder to raise capital. It doesn't seem like it's a disaster by any stretch of the imagination. And then it's also situation and sector specific.
So that multiplier, though, it's still relatively good. We have ups and downs on what that multiplier could be, but it's still on the higher end from what I'm understanding.
Yeah, absolutely. Absolutely. I think what we're seeing and I guess there's like the venture capital kind of Shark Tank venture capital market. My understanding is there's still a lot of money available. All of the venture firms and investors have a lot of money available to invest. It's high relative to historical norms. So there's still money available. Valuations have come down, but there are still a lot of transactions and investments taking place. I think there's a focus on companies that have a view towards cash flow break even and profitability sooner rather than later. And obviously there are, some sectors like crypto and stuff that are a little bit out of favor, but generally speaking, that market's robust. And then in the other market, like the mergers and acquisitions, private equity market, private equity firms have a massive amount of capital that they're managing, and their job is to put their money to work through good investments. And so while valuations are down a little bit, there's still really strong demand for investments in good companies. So I don't expect to see like a massive decline in multiples or deal flow or transaction volume like we might have seen in the credit crisis 10 years ago, et cetera.
Well, that's good. That's definitely better to hear that than the other way around. Let me ask you about something. It might be industry specific, obviously, but employees versus outsourcing. I live in the state of California. I'm in San Diego, California. They're talking about even fast food workers going up to $22 an hour. And I don't think a lot of people quite understand. Minimum wage sounds cool if you're at minimum wage, not so cool when you're trying to run a profitable business. So I keep telling people, I'm like, say goodbye to that dollar menu. It's going to be out of here pretty soon. But I also know there's a lot of companies who are outsourcing their employment as best as they possibly can to different countries where they don't have to pay the outrageous minimum wage taxes, including a lot of the Social Security, Medicare, and all the other fees that are associated with having employment. When you have buyers looking at different companies, are they looking at some of these payroll costs and, leaning more towards outsourcing employment, or does it not really even matter when you're looking at mergers and acquisitions?
It matters. It matters quite a bit. And I think, just years ago, like 15 years ago, I worked with a public company that was a offshore outsourcing company. They had they had a large employee base in the Philippines, and we were helping them acquire companies in the United States that were doing kind of call center, customer service, back office, administrative processing, et cetera, et cetera, et cetera. And these companies in the United States doing this work at the time were struggling to find, well-educated employees that were excited about doing that work. And so their growth was limited. Their growth was limited because they couldn't find employees. So our client was able to acquire companies like this and then use a labor pool in the Philippines to help those companies step on the gas and drive growth. So I think that part of the outsourcing is there can be some favorable labor rates in other jurisdictions. And in California, we're seeing a lot of companies leave the state to set up shop in other areas of the country where cost of living and labor rates are lower. We're also seeing companies use offshore labor. We're also seeing companies really focus on their core competency and outsource things that are not core to their business in the interest of efficiency and cost savings. A lot of companies are using outsourced accounting functions, outsource CFO functions, outsource this, outsource that. And it's not necessarily just a cost savings. It's efficiency, management, attention, bandwidth, et cetera. One of the things, to come back to your question specifically, one of the things buyers are looking at is, I'm looking at investing in or buying this company. How can I help the company either improve its profitability or improve its growth, or both? And if a company is not utilizing outsourcing, et cetera, often there are ways to drive growth and efficiency through outsourcing. And so I've been involved in a lot of those different discussions across a lot of different industries between buyers and sellers. And, I've also seen outsourcing is not easy. Outsourcing is not easy. Businesses have a lot of different nuances and details. And so getting the details and nuances right is critically important.
Oh, yeah, it makes all the difference in the world, because at the end of the day, the details are in the numbers. So
Exactly.
I don't know, outsourcing that CFO right before you're going to go through a merger and acquisition might not be the best bet, but I get what you're saying. There's a lot of companies that definitely, I know a couple fractional CFOs myself, fractional COOs that come in and help companies kind of get systems and processes in place. So it's definitely something that people are looking into. The cost is just much more effective that way. All right, Channing, before we head out, you've given us a lot of information. How can people get a hold of you if they want to find out more information?
So the website that's scrolling across the bottom of the screen here is a really nice way to learn more about our firm, and my contact info. My contact info is on there, and I think you can also see my email address right there. So feel free to reach out. Happy to answer any questions or talk about this stuff. I really enjoy it and would love to hear from you.
I got one last question for you. We spend a lot of time creating content on via podcasts. What's probably the most valuable thing a reason why you're going on different shows. What's the message that you're trying to get across to different audiences?
I think that I touched on this a little bit at the beginning. I think, we work with a lot of business owners, either helping them understand kind of what their company is worth, preparing for a transaction, or on the investment banking side of our business, helping business owners go through a transaction. And what we've seen time and time again is most business owners don't take the time and invest the resources to really prepare themselves personally and prepare their companies to be able to either raise money or sell their company at a premium. And so really excited about talking to business owners that are planning ahead for a transaction and helping them really think through and understand all of the pieces they need in order to make it successful. And so this pre-transaction planning is like a really critical thing that most private companies don't really put the time and attention into. And it can make a big difference when trying to raise money in terms of being successful or not. It can make a big difference when trying to sell in terms of being successful or not. And it can make a huge difference in terms of selling at an okay value versus selling at a premium value. And so this sort of pre-sale planning and education element is really something I'm excited about having people learn more about and helping people understand better.
Boom. That's it, ladies and gents. I know there's a lot of you out there who are in a situation where maybe you got parents or family members that are ready to exit. They don't know what they're going to do with their business, and you sure as hell probably don't want that business. So you're going to want to reach out to somebody just like Channing. The website scrolling across the bottom, by the way, it is objectivecp.com. For those of you who are just on the audio, objectivecp.com. Find out what your company's worth. Find out what your family's looking at as far as gaining a sale, or maybe merging it with another company, or maybe it's something that you're looking into and maybe you don't want to start a business from scratch. You want to buy something that's already fully functional and operational, cash flow positive. So these are opportunities that are all out there for you. Channing, thank you very much for coming on the show. Ladies and gents, we'll catch you guys on the next one. Peace.
Thanks for having me.
It's over. Go home. Is your business in need of marketing? Try starting a podcast, but not just any podcast. Podcast like a pro. We can show you how to take your business from being invisible to becoming a brand people trust. Go to www.businessbros.biz